G'day. Just wanted to talk about strategies to reduce tax and some of the things that I've seen in the past, and question whether they're that effective in reducing tax for the risk that they're taking on sometimes. So in the past, many business owners, including farmers, they can use farm management deposits where you put money into an FMD, and that is all about smoothing out income over many years. That in a high income tax year you can put the money away and bring it out in a tougher year where incomes are lower. And now what that does do is pushes out income into other years, and then you bring out in a lower tax income year. So that's the ideal way to use those, and they're a very good tool, particularly for younger farmers. Other strategies we've seen is about paying upfront for expenses that you may need for next year. A lot of these are all about deferring tax in a way, increasing expenses that you would have incurred in a coming year. I've also seen some business people that will go and buy a car, and I've actually seen it through salary packaging with cars for teachers and people in the government sector to buy a car, which gives them a small tax advantage. Now, the problem with vehicles, any tax advantage that someone thinks they're getting will be wiped out by the depreciation of the asset itself. So I don't think that is a relevant strategy to save tax. Other strategies, and one that I've covered off quite a few times, is negative gearing. As you know, if you've got a negatively geared house, it essentially means that the asset itself is bringing in, say, $8,000 per year, but the cost to own it might be $10,000, and so you've got a loss there. So you've lost money, and lost money of $2,000, and if your marginal tax rate is 34%, then you've got yourself you've saved tax of $680 for that year. The downside to saving that is you had to spend $2,000 to do that, and when it's an asset that could be worth between $200,000 and $300,000, it's a lot of money in one asset class. And more often than not, to get the to have these costs, there's obviously a lot of interest that you're paying, and that means that there's a lot of debt, and that increases the risk. So for me, again, that's not a preferred strategy. One strategy that is often overlooked, and it can be the most simplest and definitely the boringest strategy out there, is superannuation. So let's use the example where someone is on a marginal tax rate of that, or say 39%. So when you're over $80,000 per year in taxable income, that's your marginal tax rate. If you, for people that are over age 49, 50, they can put in $35,000 of their wage into superannuation as a concessional contribution, and you're only taxed at 15%. So that's a pretty healthy saving when compared to the marginal tax rate here of 24%. And if you've got a marginal tax rate of 34%, that's another very healthy saving of 19%. So very boring. Some people might say, oh yes, but I don't want to invest into the superannuation, I don't like shares. Well, that's not a decent argument, because superannuation is merely a tax structure. If you don't like shares or property, you can just invest into cash. If you say, Rob, I'm a property person, I want to invest into property only, you can select a property fund within your superannuation, and that will target more than likely listed property trusts that own lots of buildings like the Westfield shopping centres. So I think the focus should be on the tax saving, the value you get for the tax saving, and the amount of risk that you take on in the other strategies, particularly taking on debt to chase tax deduction. I think you've got to be very careful around that, and at the end of the day, spending $2,000 to save $680 for me is not something that I'll be chasing. Speak to you soon.